Let me tell you guys about the basics of the stock market. So these are really important basics for beginners to understand about what the stock market's all about. The first thing is that the stock market is a collection of stock, which means ownership in companies that are out public, which means they have sold off chunks of their company to you and me and everybody else out there. Now, together as a group, we call all of these companies together the stock market. And we usually look at the value of the market going up and down based on a specific number of stocks like the S&P 500, which is a group of the 500 best companies out of the maybe 4,000 or 5,000 companies that are out there in America in the public markets. Now, here's one of the most important basics I can teach you, is that the myth is that the stock market goes up in the long run. The truth is, in the long run, we're all dead. Which means that there are times when the stock market does not go up, and those times are longer than you have left on the planet. Sometimes the stock market doesn't go up as much as 25 years in a row. That's a long, long time. In other words, from 1929, if you'd put your money in the market, you would have broken even in 1955. So we want to be sure we understand how to invest in a market that can go sideways or down and really doesn't go up all the time. The second thing I want you to know is that most of the people who professionally invest money don't do very well with it. 96% of the mutual fund managers do not beat the market in the long run. That's kind of astonishing, isn't it? Which means if you put your money in the hands of a mutual fund manager and they charge you a bunch of fees, you're getting nothing for your money. And the next thing to know is that the compounded average return in the stock market isn't what Susie Orman says it is, 12%, or what David Bach says it is. I think he says it's 11%, or Dave Ramsey says it's 12%. No, the compounded average return in the stock market over the last 120 years is 5%, not 11 or 12, 5%. So even when you put your money in the market and it goes up, over the long run, it doesn't produce that great of a return. All right, the next real important thing for you to know is that while the best time to sell a stock is never, of the 500 companies in the United States in 1965 that were judged the best 500 companies, only 86 of them are still in business as an independent company. 86 out of 500. That tells you something about having to understand what you're investing in. So let me add one more thing. The key to success in the stock market is real simple. You buy a wonderful business that's going to survive for the next 10 or 15 years, and you buy them when they're on sale. So to do that, Warren Buffett and Charlie Munger say we've got to have 4 simple things in each investment. First, we've got to have an investment we're capable of understanding. That means we need to understand the business. Second, the business has to have intrinsic characteristics that make it a durable business. It's going to be around a long time and profitable. Third, that we want a CEO who's talented and who has integrity. And fourth, we want to know the value of the business and that it's on sale. It's really great hearing from you guys, so please leave me a comment below, and thanks for watching. For more videos like this one, please subscribe to my channel.